Goldman Sachs CEO sees good chance of recession. He advises investors to be cautious, prepare for more difficult environment. The CEO of global investment bank Goldman Sachs, David Solomon, sees a good chance of a U.S. recession. He stressed that the environment heading into 2023 is one that you've got to be cautious and prepared for. I think you have to expect that there's more volatility on the horizon now, the Goldman CEO continued. That doesn't mean for sure that we have a really difficult economic scenario. But on the distribution of outcomes, there's a good chance that we have a recession in the United States, in an environment where inflation is more embedded and growth is slower. Asset appreciation will be tougher, he cautioned. Are we going to get rooted in that kind of a decade-long scenario?
$8.25 a share. The consensus estimate was $7.69. I had what should we use? Oh, David's here, which is really exciting. Joining us now. Andrew, you want to do it? But I've got a revenue number 11.98. Yeah, that is above 11.4. Yep.
Yeah. And you're looking at the stock, by the way, moving already, about 2.5% up right now. Joining us in an exclusive interview is Goldman Sachs' CEO, David Solomon. Nice to see you, sir.
It's nice to see you guys.
On set
really
at the table.
Really happy to be here. Really happy to be with you on set.
We've been joking with you for years now that you're an in-person guy, so now it's nice to see you in person.
It's nice to be in person. It's nice to be with you.
Let's talk about these numbers, and let's also talk about the other big headline that a lot of folks in Wall Street are talking about, which is this reorg of what's happening inside the company. But in terms of the numbers, better than expected. But there's a lot of questions about what the future of this firm is going to look like. So speak to it, if you could.
Sure. Well, on the numbers, this was a challenging operating environment, certainly for a capital markets-centered firm. There has not been a lot of capital markets activity, given the headwinds of economic activity. Equity issuance, debt issuance has been slower. M&A activity was still relatively robust, and I think strategic dialogues still remain pretty good at this point in time. Our clients were active, though, and the thing that I'm most proud of when I look at the way our team's done over the course of the last few quarters, if you look at our market shares and our wallet shares, we're really focused on our clients, and we're really doing well in servicing them and being there with liquidity and capability and financing, to meet their needs. What's a very challenging time.
In terms of thinking of you, though, as a bellwether for the capital markets, what are you expecting in terms of the next, when you look out over the next couple of quarters, what does it even feel like to you?
I think it feels uncertain. And, I think there's no question we're tightening economic conditions relatively quickly. We're reversing what's been a very, very long period of relatively easy economic conditions. And at some point, there's going to be a bigger impact on consumer behavior, on market behavior. I think we've started to see that. But I think until we have a better trajectory on the direction of economic activity, it's hard to really know where markets settle. So I think it's time to be cautious. If you look at what most economists are predicting, they're predicting slow to no growth in the U.S. They're predicting negative growth across other developed economies in Europe. And so that environment heading into 2023 is one that I think you've got to be cautious and prepared for.
So to the extent that you have to place a bet on where to put your own business, meaning is it trading where you think that the growth is going to come? And when you look out over the next year, to the extent there's opportunity, if there is one, what is it?
Well, I think there's a lot of opportunity with our clients because our clients are resorting their position, given the fact that the world's changed. We're entering a period where there's more embedded inflation. Obviously, the Fed's focused on taming that, but we're shifting the economic environment materially. Right. I think big businesses are looking at how they're strategically positioned and saying, how do we adapt to that? Scale matters a lot in an environment like this. People are shifting supply chains. It's not that everything's onshoring, but they're thinking more strategically about certain supply chains. And so as you look ahead and think about that, I think our clients will continue to be active, and we're there prepared to serve them. And we don't really think, Andrew, we're not looking quarter to quarter. We've got a leading investment banking business, a leading global markets business. We have an extraordinary asset and wealth management platform, and all of those are set up to serve clients. And this reorganization of the way we're organized really comes out of our One Goldman Sachs ethos to try to say, how can we continue to position ourselves to serve our clients better?
Of noise in the trade statistics. I think some of that is going to unravel, but I think it's really about higher interest rates, lower stock prices, somewhat wider credit spreads, and to some degree the appreciation of the dollar. But all of those different drivers, which are primarily going to impinge on domestic demand, slowing growth to a much lower pace.
Do you see any indications at this time that the labor economy is easing? Is it in the microdata that you look at every week?
Not yet in the data, no. I think there are some signs in the more anecdotal reports, company by company reports, some of the tech firms scaling back hiring, lowering open positions. In the hard data that get published by the Labor Department, not yet.
Jan, how high does unemployment have to get to reach that sort of spare capacity that you're looking for in the labor market?
I actually don't think that the unemployment rate has to rise a lot. What needs to happen, I think, is that companies bring down open positions. So the path that the Fed's targeting is to slow growth to a pace that is slow enough for companies to shelve some of their expansion plans and bring down some of their open positions, but not so slow that you start getting large numbers of layoffs. So we're expecting a little bit of an increase in the unemployment rate from the 3.5% range to the 3.75% range, but not a large increase.
Do you think that basically Michelle Meyer was correct when she was talking about the ability for consumers to lever up even if their incomes aren't keeping pace with the inflation rate right now, and that basically the Fed has to go a lot faster even still than people seem to think in order to slow that? Otherwise, we're going to get even more overheating.
Well, I think borrowing is going to be a short-term. Has been to some degree. If you look at the consumer credit numbers over the last couple of months, there clearly has been some, re-leveraging to some degree. But I don't think that that's going to be a lasting kind of, support for spending. So I think consumer spending is going to be relatively slow. Income is going to be quite weak in 2022. We're looking for only 0.5% real income growth on a fourth quarter to fourth quarter basis. On an annual average basis, actually significantly weaker than that. But even on a Q4 to Q4 basis, only 0.5. And I think that's going to keep spending pretty soft.
Long ago and far away, there was Dudley and McKelvey and this young whippersnapper from Germany. What was his name? I think it was Hotzius is what it was. And you codified MEW, mortgage equity withdrawal. Let me cut to the chase, Jan. When does the housing market break?
Well, MEW is actually a very important issue again. Not as important, I think, as going into the 2008 crisis, but there has been a pickup in mortgage equity withdrawal over the last year, and you've had this increase in consumer credit as well. Similar kind of dynamic. This supports spending in the short term, but ultimately is not going to be a sustainable source of big increases in spending. So builds in a slowdown sort of down the road. And I think when the housing market slows, of course, is going to determine the timing of that. We haven't really seen significant slowing in the hard data yet. I do expect it. Mortgage rates are up even more than 10-year Treasury yields.
I just ask because Farrell wants to know, should he buy in June or July?
I'm not going to give him advice on that. That I think is probably not
advice I was after, Jan. Don't worry.
That's too long-term for Jan.
Jan, let's finish here just quickly. What's the biggest risk right now, to your view?
Well, I think the Fed is still trying to bring down, slow the economy, slow employment, and bring down open positions because they're still worried about inflation being too high. And it will be well above target for the foreseeable future. I do think it's going to come down. But if it doesn't come down quickly enough, we can see, still significantly higher rates. Our call at the moment is 3 to 3.25% for the funds rate. We've stuck with that. And it's, fairly close to market pricing. But I think the risk case is that, they have to do more. And that then also raises the risk of